Welcome back. Let's look at cash flow quickly. You know, cash flow doesn't make you any money, but cash flow keeps you in business. Cash flow comes first out of all of your business principles. You can make big deals on credit and whatever, and you can go bankrupt. Well, theoretically, your books are saying you're doing very well. But cash is king. Cash is absolutely the boss. You know, at the end of the day, I think everybody in business would rather that their bank manager was wearing the knees out on his trousers in your office, looking for your business, than you are wearing out the knees of your trousers in your bank manager's office, trying to borrow some money to keep your business going. How do we calculate the cash flow that's coming into a business? You know, it's very simple. Really all that you need to do is you look at your bank balance at a specific point in time, and then you can add to that bank balance. If let's say that you've got a hardware store sort of business, and you know from previous months, previous years, what that last week of your month's sales are going to be. You know, most businesses average out to a large degree against previous years, previous months, whatever the story is. So it's fairly easy to sit there and say, all right, this is my current bank balance. This is the turnover that we should do over the next week, let's say. And then you also know, because the most important time to look at your cash flow is at month end. Because month end, when you're a business owner, month end is completely different from, say, anybody that's an employee or anything. Because all people that work for other people are being paid at month end. Whereas you as business owner are paying out all of your money at month end. You're paying your rent, you're paying your vehicle finance, your bond finance, or your rent. It's month end, it's money out time. So as a rule, as a business owner, you'd have a pretty good idea of how much money you need at the end of the month to pay for all of your month-end expenses. And in essence, what you've got to do is simply make sure that what you've got in the bank right now, let's say, plus what you're going to bring in over the next week, will cover your month-end expenses. You know, there's some very simple rules. And one of them is you buy your stock at the beginning of the month. If your supplier is giving you 30 days credit, buy your stock early in the month, and you've got the whole month to sell it before you actually have to go and pay your supplier. There's not much point in getting a delivery from your supplier just before the end of the month, and the guy's going to start shouting at you for the money early in the next month. So those are your absolute basic rules of looking after your cash flow. But there's certain other circumstances, certain other situations, depending on the nature of your business, that you must consider very carefully. You know, at the end of the day, if you are a business owner, you are actually your own business's private bank manager, because you really are the person that's got the last say on what your money is spent on. But you also are responsible for how your money comes into the business. And if the nature of your business is such that you can give people credit, you must look very carefully at who you give credit to and how much credit and the terms that you give those people. You know, I'll give you an example, and this is from experience. Being involved in a business that was in distribution of food products, and they got themselves into a situation with one of their customers who was basically a restaurant owner. And if you think about it, a restaurant owner, unless you're in industrial catering, I'm talking about a normal restaurant, your customers come and eat food that you prepare for them, and they pay you and they leave. It's a cash business, a restaurant. And somehow the owner of this restaurant had been given a bit of credit. And this credit had grown and grown and grown until he probably owed money that was very close to 4 months of his total turnover to one supplier. What is happening in this situation is that you, the supplier, are allowing the situation to get totally out of hand. Because when a person owes you so much money and the person's not keeping up to date with the payments that he should be making, your customer is actually starting to become your boss. Because the only threat that you can make at that stage is to stop supplying him, and he can go to other suppliers. Or you can threaten him with liquidation stories if he doesn't pay you. You got yourself into a situation that's a complete farce, basically. Because by allowing the amount of credit you're giving one of your customers just to get too far out of hand. You know, most cities or areas, most people in a similar kind of business know each other in the other businesses. After all, those people are your opposition. And quite often, I think it happens most cases, is everybody that's in a certain kind of business all does well together or all does badly together. You tend to start looking after each other rather than being competition. There's various names in certain industries, they call them cartels and things. If it starts getting a little bit too out of hand, where businesses get together to make sure that they're making as much money as possible. But what I'm trying to get at is, if a customer is doing you down and you're in distribution of, let's say, food products, it doesn't take too many phone calls to also tell all the other suppliers that you're related to about this particular customer, what this person's gotten up to. But when you allow things to get out of hand, very often is you're going to lose all that money that you've allowed that person to have on credit from you. You know, the bottom line is, when you're running a business, you're not a bank. And if you sell to a restaurant and they're selling for cash, at the most, you possibly give them 7 days credit. Sometimes you implement a system like that. Just makes it easier for your deliveries, that the guys can drop the stuff off at all of your customers' premises. They don't sit and wait for money. In our country, in South Africa, it's a situation that very largely we've been forced to follow, because people were targeting the trucks to rob the cash. And it puts you in a situation where you've got to tell all your customers, listen, we just can't take cash from you. It's too dangerous for our drivers, plus the office staff. And then you explain to them that what we're going to do is, at the end of the week, say every Monday morning, is we'll send you our statements saying what you asked from the previous week. And then you must do an EFT into our account. And sometimes when you're forced to change, let's say, from cash on delivery to a system like that, it's meaning that you're trading for a week in a cash arrears sort of story. Normally you would have received during that week cash for all of your deliveries. Now, because you've been forced to change over, as you've provided stock to all of your customers for a week without being paid, and you're only going to collect the money in the next week. And so sometimes what you'd have to do is actually go to your suppliers and explain to them, listen, it's just too dangerous for us to get cash. So we're having to give everybody 7 days credit. And so please give us an extra 7 days to pay you. The supplier, when you've got a reasonable story like that, is obviously going to listen to you and say, okay, that's fine. Your supplier wants to carry on doing business with you. You're in that situation. You've got no option. You know, the last thing I think I want to say about cash flow, you only give it when there's a very, very, very valid reason for a person needing to be given credit. People must finance their own businesses. They can't expect you as the supplier to finance their business. They must finance their own business. But obviously in certain circumstances, like I've just mentioned, there are very valid reasons for giving people credit. The last thing I want to say about this is if you sit down and you print out, it's called an age analysis, a debtor's age analysis. So it's a summary of what all of your customers owe you, and it will give you a breakdown, a schedule of how much they owe you per aging period. So if you're giving your debtors, let's say 30 days, there'll be the current amount that they owe you, a 30-day amount that they owe you, 60 days, 90 days. Now obviously that 60 and 90 is overdue. One of the things that you must do if you are running your own business is to really sit down and look at all of your debtors, because there's absolutely no point if one of your debtors has gone bankrupt. The person's never going to pay you any money, and you're better off getting your accountant to write off those bad debts. If nothing else, at least it gives you a bit of a tax benefit. But there's absolutely no point in keeping numbers in your books that are totally unrealistic. The same actually applies to stock, but we'll come to that when we're talking about stock, which will be the next video. And from the next video, now we're really starting to drill down into how to understand where you're making money or not making money in your business. Thank you very much for listening.